price engine, how your premium is really set. Let's open the hood. Every premium is a stack: loss cost, reinsurance, expense load, and a target margin that keeps the combined ratio where executives want it. Loss cost is the actuarial core. What similar risks have actually cost in claims, adjusted for your specifics. That number gets pressure from inflation, parts and labor, medical costs, and where you live. If your zip code just had a hail spike, or your hospital market consolidated, loss cost inflates before you even touch coverage. Now add reinsurance, which is your insurer's insurance. When reinsurers raise rates after storm years or widen deductibles on their contracts, your carrier passes that through in two ways: higher base premiums and bigger catastrophe deductibles. That's why you'll see wind or hail deductibles quoted as a percentage of dwelling value instead of a flat number. One event becomes a five-figure self-insured bill. Next is the expense load. Think claims handling, call centers, IT adjusters, and this is big distribution costs. If a broker or agency placed your policy, commissions and contingent bonuses are baked in. Contingents reward volume, retention, loss ratios, and growth, which quietly nudges steering toward markets that pay the broker more, even if a different carrier would be better for you. With private equity-owned distributors, the incentive to harmonize pricing and upsell add-ons only intensifies. Riders sound protective. Many duplicate what your base policy already covers or carry sublimits that don't move the needle. Finally, the margin. Carriers target a combined ratio below 100, claims plus expenses divided by premium. Miss it, and they re-rate classes, prune geographies, or tighten underwriting. Hit it, and they still may push for rate adequacy in underperforming segments. Translation: even clean risks can see increases if your cohort underdelivered on profit. Here's where the squeeze appears in the wild. Catastrophe models are recalibrating for secondary perils: hail, convective storms, wildfire smoke. If your roof is older or your area's frequency chart lights up, expect a surcharge or coverage carvebacks. Cosmetic damage exclusions, actual cash value on roofs, special deductibles. In auto, repair severity went up with parts costs and sensor-laden bumpers. If your vehicle has advanced driver assistance, one fender bender can look like a surgery bill. The renewal trap hides in defaults. You get a no material change letter, the premium is up 12%, and 3 new endorsements slide in. Bundling discounts mask the real price of each line. In health, network shifts and formulary changes quietly convert your in-network to not here anymore. In property, water backup endorsements flip from included to sublimited. If you don't audit line by line, you pay for less. So, how do you claw back 15 to 35% without getting underinsured? Start with a coverage audit. List exclusions, sublimits, and co-insurance clauses that punish you at claim time. Drop duplicate riders. Roadside assistance you already have from the automaker, identity theft you get via a bank, device protection that overlaps warranties. Reclaim dollars for real risk. Second, shop the market the smart way. Use an independent broker, and also pull at least one direct carrier quote. Ask for bindable quotes, not indications, so you can pit final numbers. Require a coverage matching worksheet. Same dwelling limit, perils, deductibles, sublimits. Apples to apples stops the cheaper because it's weaker trick. Third, attack reinsurance-driven surcharges. On home, ask for a roof schedule option, higher roof deductible in exchange for lower premium, only if you've budgeted for that risk. If your roof is newer, push back on ACV settlements. Replacement cost often prices cheaper than you think when you show proof of age and material. On auto, raise comprehensive and collision deductibles strategically while adding a repair fund. Net savings often outweigh the extra out-of-pocket on unlikely events. Fourth, force a re-rate with your loss runs and records. For home and auto, request a 5-year loss run and MVR/CLU data. Challenge phantom losses, closed without payment entries, and incorrect drivers or garaging. A single bad data point can add hundreds. For small group health, ask your broker for the claims experience and high-cost claimant impact. If one outlier drove a spike, level-funded or captive options can price truer to your group's baseline. Fifth, calendar your renewals. Stagger policies so you're not shopping 3 lines in the same month when time is scarce. Set a 60 to 90-day pre-renewal window. That's when underwriters still have appetite and brokers still have time to advocate. Last-minute quotes come with panic pricing. Watch the broker spread. Ask how your broker gets paid, base commission, and any contingent. Then request options with lower comp markets and fee-based placement. When the broker sits on your side of the table, transparent fee. They're freer to push carriers on price and terms. If they won't disclose, that's your shopping signal. Now the PE-owned distributor angle. Rollups often standardize offerings. Great for them, expensive for you. If your brokerage changed hands, compare last year's coverage graph to this year's. Did they move you to house-favored carriers? Did admin fees appear? You're allowed to move your business, even if the same producer calls you. Loyalty is fine, just make them earn it. Bottom line, premiums rise when loss costs, reinsurance, and expenses stack, then margin targets seal the lid. Your countermoves are documentation, timing, and coverage precision. Strip waste, fix data, demand comparables, and use deductibles like levers, not landmines. Because every dollar you prevent from entering the rate base of your policy is a dollar you keep for an emergency fund that actually protects you when a claim hits. The algorithm of no, auto denials, and adjudication drift. Now the part you feel after the bill, when you file a claim. Here's what actually happens behind the portal. Your submission hits a sorting layer that isn't reading your story, it's scanning for patterns. Timing, codes, modifiers, phrasing, provider type, prior authorization status, and historical utilization. In milliseconds, automation assigns a path: pay, pay less, pend, or deny. Most people think a medical director studies each case. In reality, rules engines and scorecards clear the majority before a human ever looks up. Soft denials are the first wall. The notice says need more information or not enough documentation to adjudicate. That sounds fair. It's designed for drop-off. Insurers know a chunk of people won't resubmit or will miss a deadline. That abandonment saves payouts without saying no. In property claims, you'll see coverage under review while they request photos you already uploaded, logs you've already sent, or contractor estimates with extra formatting. Each round restarts the clock. In health, pens for missing chart notes, incorrect place of service codes, or missing modifiers push the claim into a second pass at lower priority. Downcoding is the quiet squeeze. A provider bills a level 4 visit. The system maps it to level 3. A surgical code bundles into a cheaper family. A laceration repair is recast as simple instead of intermediate. You won't see denied. You'll see paid at a reduced rate. For you, that means higher coinsurance against a lower allowed amount. More out-of-pocket for less care on paper. In dental, periodontal scaling becomes adult prophylaxis. In pharmacy, brand medically necessary becomes therapeutically equivalent generic, triggering step therapy you never agreed to. Prior authorization is delay as strategy. The criteria live in manuals you rarely see. Medical necessity is defined by proprietary guidelines, not the clinical notes you read. Requests penned for peer-to-peer reviews that can be scheduled next week, and approvals arrive with expiration windows too short to align with operating rooms or specialist calendars. If you cancel and reschedule, you restart. If you miss the window, the case closes. Most people think the fix is yelling. The fix is documentation that forces a peer, with a deadline and citations in the policy's own language. Appeals math is simple and brutal. Stage 1, internal review by the same entity that denied you. Stage 2, second-level internal review, often by a cubicle over. Stage 3, external review, where wins often happen, requires you to survive the first 2 cleanly and on time. Every missed form, date, or magic phrase pushes you back a square. So we flip the flow. File-proof your claim at the start. For property, time-stamped photos, serial numbers, inventory spreadsheets with model numbers, and videos panning rooms before loss. Keep receipts in a cloud folder. Log phone calls with dates, names, and promises. For health, precision on ICD-10 and CPT/HCPCS codes, correct modifiers, place of service, and linking diagnosis to procedure in notes. If it's complex, ask your provider's billing team to add the supporting documentation up front. Progress notes, conservative therapy tried, radiology reports with measurements. Use the payer's policy against the algorithm. Request the plan document, summary plan description, and clinical policy bulletins for your procedure or drug. Highlight the criteria you meet. In your submission, mirror their language. Meets criteria X, Y, Z as defined in Policy ABC Section 3.2. That converts clinical opinion into compliance. If it's employer-sponsored, ERISA gives you the right to plan documents, claims files, and relevant documents relied upon in denial. Ask in writing, certified mail. Missed deadlines by the plan can trigger deemed exhaustion. That moves you to external review faster. Set appeal timelines on a calendar with alarms. Stage 1 appeal. Submit within the window, cite policy sections, attach all evidence, and state, I request the entirety of the claim file, internal notes, and any external reviewer reports relied upon. Demand confirmation of receipt. Stage 2. Repeat with additional evidence and point out process failures, missed response times, failure to consider new evidence. Stage 3. Trigger state external review, or federal, if ERISA preemption applies. External reviewers often overturn when the record is complete and policy criteria are clearly met. Use escalation ladders. For medical, physician-to-physician peer review with scripts. Doctor-to-doctor peer requested per policy, requesting reviewer with specialty match. Clinical criteria ABC at hand. If denied, escalate to a medical director. For network, escalate beyond the call center, provider relations, then market president. For property, desk adjuster, senior adjuster, field manager, then claims leadership. Keep everything in writing. Summarize calls by email to the adjuster and CC your file. Exploit timely access rules. Many states cap response times for prior auth and urgent appeals. If a deadline is missed, request automatic approval per regulation citation. In pharmacy, invoke continuity of care, temporary fills during transitions. In hospital settings, ask for concurrent review with bedside clinicians present. Force real-time decisions instead of retroactive denials. Document bad faith patterns. Repeated requests for documents already provided, contradictions between EOB and denial letter, missed statutory timelines, or changing reasons for denial at each stage. Build a pattern memo. It's leverage for regulator complaints, employer HR escalation, self-funded plans hate noise, or counsel if needed. Last piece, use clarity to shorten the game. The algorithm exploits ambiguity and fatigue. Replace both with evidence, policy citations, and clocks you control. Once you speak their language, no becomes prove it, and prove it is a fight you can win. Betting on disaster, cap bonds, reinsurance, and your bill. Everything changes when you see the second balance sheet, your insurers. They don't simply take your premium and hope for a calm year. They buy protection too, and the price of that protection flows straight into your renewal. Start with the reinsurance cycle. When big losses hit, hurricanes, hail swarms, wildfires, reinsurers raise rates and push up retentions. Your carrier pays more for a thinner safety net, so two things happen. Base premiums climb and event deductibles swell. That's why wind and hail deductibles shift from $1,000 to 1 to 2% of dwelling value. The reinsurance bill gets socialized through your policy. Then there's the other safety net, catastrophe bonds. Think of a cat bond as a disaster swap. Investors collect a rich coupon as long as triggers don't fire. If a defined event hits certain thresholds, principal funds your carrier's claims. Yields were eye-popping recently, high teens in 2023 to 2024, and issuance set records. Great for investors, but here's the part most people miss. Your premium helps pay those coupons. Whether the bond triggers or not, you fund the ticket to ride. Triggers matter. Traditional cat bonds use parametric triggers. Wind speed at a station, quake intensity, modeled loss above X. That's fast money for carriers. But speed cuts both ways. If the instrument doesn't trigger, say the wind measured 2 miles per hour short across the box, your insurer still ate losses in your region, and they still need to recoup. Cue post-event surcharges and midterm filings to restore capital. You pay now and later. Climate isn't a headline here, it's pricing geometry. Secondary perils, severe convective storms, hail, flood, are repriced with finer granularity. Models recalibrate zip by zip, roof by roof. If you're in a hot cell, the reinsurance load assigned to your cohort spikes, even when your individual risk looks tidy. That's how you end up subsidizing a county over, and it's why the cleanest claim history doesn't always save you. After a major event, watch for the recoup sequence. First, your carrier's cat cover may attach high. Losses below the threshold are theirs. Second, if the bond didn't trigger and traditional cover exhausted at a high layer, your carrier plugs the gap with surplus and debt. Third, regulators often allow catastrophe recovery, riders over the following terms. None of those steps mention you, but each shows up in your bill. Moral hazard comes up a lot. Are investors betting against your house? Practically, no one roots for catastrophe, but incentives do diverge. Portfolios prefer stable triggers, high coupons, and diversified peril baskets. Carriers prefer quick, certain payouts. Regulators prefer solvency. You prefer affordable, reliable coverage. When those preferences collide, the easiest lever to pull is your premium and your deductible. So, what do you do with this? You can't price reinsurance, but you can change how reinsurance prices you. Reduce your modeled loss, not just your aesthetics. Underwriters map roof age, materials, attachment, and mitigation. If you've upgraded roof, underlayment, or secondary water barrier, document it. Bring proof, permits, invoices, photos. Ask your agent to request a roof schedule credit or a reduced roof factor based on material and age. Separate peril deductibles strategically. Consider higher wind/hail deductibles paired with a dedicated reserve, while keeping all other perils lower. That can cut the reinsurance load allocated to your policy without turning every kitchen leak into a budget crisis. Challenge geography creep. If your address picked up a convective storm surcharge after a hail year that missed your census block, ask for the map. Some carriers will re-rate when you supply roof condition evidence and local loss runs. Precision beats pleading. Use bindable comparables. When you pick carriers, demand bindable quotes with the same peril deductibles and special sublimits. If one carrier's cat load is materially lower, show that to your incumbent and request a re-rate. Underwriters compete when you hold apples to apples. Time your roof like a refinance. In many markets, re-roofing with impact-rated materials immediately shifts your modeled loss and unlocks. Replacement cost on roof again. Ask for an off-cycle endorsement and midterm premium adjustment. Don't wait 11 months to capture the credit. Expect and plan for recoup riders. If your state allows catastrophe recoupment, earmark that line item when it appears and offset it with higher deductibles you've pre-funded. The discipline is the protection. Health plans feel this too quietly. Parametric drought, wildfire smoke disruptions, and utility failures create surge costs that self-funded plans and stop-loss carriers price the next year. Employers can blunt it with disaster continuity planning, backup locations, telehealth capacity, refrigeration protocols, because avoided surge is avoided reprice. Here's the plain language. The global safety nets your insurer buys are not abstract. They're a conduit from Wall Street to your mailbox. You won't change the cycle, but you can narrow the target painted on your address and reclaim dollars the models don't deserve to collect. That's leverage you control. Mitigation with receipts, peril-specific deductibles aligned to cash, and comparables that force underwriters to sharpen the pencil. And when the surcharge letter lands after the next storm 3 counties away, don't rage, re-rate. The insurance-to-debt pipeline, deductibles, medical cards, and financing. This is where a premium increase turns into a balance you carry for months. High deductibles were sold as skin in the game. In practice, they're crisis loans you extend to yourself at the worst possible moment. Coverage doesn't really start until you've drained cash you needed for everything else, and the gap gets bridged by plastic with medical branding and double-digit APR. Start with the structure. A $6,000 family deductible means the first $6,000 of medically necessary care comes from you. If the plan has coinsurance after that, you're still on the hook for a percentage until you hit an out-of-pocket max that can sit north of $14,000. One emergency room visit plus imaging plus a specialist consult can eat half the deductible in a weekend. That's before pharmacy tiers, facility fees, and separate deductibles for out-of-network accidents. Enter the sales pitch at checkout. We partner with a healthcare financing card, interest-free for 6 months. Sounds helpful. Read the terms. Many medical credit cards use deferred interest. Miss the payoff window by 1 day, and they backcharge interest on the entire original amount at 20% plus APR. Providers like these programs because they offload collection risk immediately. You leave with a swipe, they get paid, and future you inherits compounding. Hospitals also push in-house payment plans. Some are fair, 0 interest, 12 to 24 months, no hard credit pull. Others kick the debt to third-party financiers with junk fees and acceleration clauses. A late payment can collapse the plan and send the full balance to collections. Ask 3 questions before you agree. Is there interest? Who owns the paper after day 30? What happens if I miss one payment? Get the answers in writing on letterhead. Out-of-network traps multiply the pipeline. You check in at an in-network hospital and meet an out-of-network anesthesiologist or radiologist you didn't choose. Surprise balance bills still happen despite reforms, especially with facility-based providers and air ambulances. Your insurer applies out-of-network deductibles or lower allowables, leaving you a balance you never planned. Providers then offer financing on the spot, again, at rates that belong on a retail card, not a medical necessity. Pharmacies at a parallel lane. The plan denies a brand drug after step therapy. You pay cash to avoid a flare, and the pharmacist suggests a finance option integrated into the point of sale. That keeps you medicated today, while turning adherence into revolving credit tomorrow. There's a better route. Ask for pharmacy cash prices, discount networks, manufacturer copay cards, and patient assistance eligibility before you swipe. Often, cash beats the plan's negotiated price on generics, and manufacturer programs bridge brand costs without interest. Property claims have their own financing flavor. A water leak hits, the adjuster is slow, contractors want deposits, and a convenience loan is baked into the restoration contract. You sign to get crews moving. Weeks later, the claim pays less than expected, downcoding of line items, depreciation holdbacks, cosmetic exclusions, and you're repaying a balance on materials you thought were covered. Avoid this by separating scope from financing. Get a written, adjuster-agreed scope of loss first. If you must bridge cash, use a low-rate personal line you control, not a contractor's captive loan with fees tied to the invoice. Here's how you break the pipeline before a claim. Align deductibles to cash. If your family can truly cover $2,000 without debt, set deductibles near that number and bank the premium savings difference automatically into a separate account every month. Treat it like a bill. Label it deductible reserve. When the inevitable happens, you spend your reserve, not a future, at 22% APR. For home and auto, pair higher deductibles with a dedicated repair fund and strict vendor vetting. No same-day financing, no bundled warranties you didn't price. For health, pre-shop big care. Call hospitals and imaging centers and request the cash price and the insured price for the CPT code you need. Ask for a prompt pay discount in writing. In many markets, cash or prompt pay beats your plan's allowed amount once you factor deductibles, and you avoid financing altogether. If you go this route, verify how the provider will submit or not submit the claim so you still get credit toward your deductible if that matters to your yearly plan math. When financing is unavoidable, structure it on your terms. Avoid deferred interest cards. Compare a credit union personal loan, a % promotional card you control, and an actual hospital % plan with no acceleration. Pick the option with transparent amortization, no retroactive interest, and hardship provisions in writing. Then automate payments from your dedicated medical fund so you're not juggling dates. None of this works if you can't predict the bill, so fix accuracy first. Request itemized bills and medical records for any 5-figure statement. Audit line items, duplicate charges, wrong modifiers, upcoded evaluation levels, facility fees for services delivered in office suites. Dispute in writing within the window, and demand a corrected claim submission before you agree to any plan. Every $100 you remove here is $100 that never compounds. Last step, set household rules. No signing at point of service without a written estimate and the options above. No contractor financing. No medical card applications without a review period. Every debt proposal gets a cooling off window. You're not denying care, you're denying expensive speed. That's how you keep the card in your wallet from turning into a bill you resent every month.